Good evening and welcome to week 5 of our multifamily masterclass. This is going to be the last session of this series, and tonight we're going to go over mainly how I analyze deals. So I'm going to share the method I've developed. It's constantly evolving. I'm constantly adding and tweaking things, but I've got a pretty good system down. I'm going to share that for people so they can use what I use, and then you can apply your own methodology to it. And you might look at it a little different than I do, but I think it's a really good basis to start looking at these deals if you don't have a system yet. Give me just a moment. I'm going to share my screen here and we'll get started. Okay, so multifamily masterclass for passive investors, week 5. I wanted to say something real quick too about the word passive as far as passive investing. It kind of gets a negative connotation like in our society. So I was kind of passive. It's not going to, it sounds kind of negative. I want you to dispel that. Being a passive investor is awesome. And the word, I wish there was a different word for it, but I think it's something that I have problems with that word. I wish there was a better word for it, but that's just what we generally call investors that are not participating actively. So let's get right to it. First of all, disclaimer, everything tonight in this presentation, these documents for educational purposes only. I'm not giving people legal, tax, financial, or other types of advice. Investors should consult their own professionals. All investments have risk. Make sure you understand the risk profile before investing. I'm not guaranteeing investment returns or outcomes related to real estate investing. And this document contains information from sources that I believe to be reliable, but I can't guarantee it's reliable or it will continue to be reliable. And anything in here that's a financial production is basically believed to be reasonable, but it's based on assumptions, hypotheticals, and estimates. And finally, nothing in this document has been reviewed or approved by the Securities and Exchange Commission. So let's start with what we're going to cover first. First of all, we're going to cover the number one rule of investing. And this is my most important thing. I think I've emphasized it almost every week. I'm going to continue to emphasize it. We're going to talk about it again tonight. Number 2 is going to be my method of evaluating deals that I've developed. It's a little different than any other one that I'm aware of. I'm not saying that mine is the best, but mine works really well when it's used properly. And you can take my system and borrow it and improve it. And if you come up with something better, a way of improving it, I love getting feedback. I'm always trying to improve all my processes. Strategic elimination. We're going to talk about saying no to almost every deal and why saying no is the most important thing. And it's better to say no to a great deal and miss it than say yes to a bad deal. So focus on saying no quickly, not wasting a lot of time. And once you say no on a deal, keep it as a no. Don't change your mind on it if it really violates one of your principles. We're also going to talk about developing an investment criteria or a buy box. I have my own. We'll be talking about it during this time, but everybody's is a little bit different, and yours might be a little bit different, especially in the locations you invest in because of wherever you're watching this from. And then finally, we're going to talk a little bit about goal setting and taking action, which is by far the most important thing. These are the most important skills in investing, is goal setting and taking action. So the most important rule, and we get this from Mr. Warren Buffett, we're going to invest like him. And it's very simple. His rule number 1 in investing is never lose money. So his goal is to always never lose money. And his rule number 2 is never forget rule number 1. Now, a lot of people say, well, Warren Buffett, he's like a stock market guy. He's not a real estate guy. Warren Buffett is a private equity guy. So he does not invest in the stock market the way that you or I would. He doesn't buy 100 shares of Coca-Cola and sit around and see what happens. He buys such a large percentage of companies that he's able to actively affect the management, the board, the CEO, the management. He goes in and changes companies. He invests in companies. And if you remember from one of the previous lessons, investing in commercial real estate is private equity. You're investing in a business. So think about it, investing in it as a business, and make not losing money your number one goal. You do not want to lose money. Okay, the deal method. This is the method that I use, and deal is an acronym. And I'm going to go through these, and then we'll cover all the parts of the acronym in detail. So D is for debt. This is the debt structure. It's the loan type. Is it a fixed rate? And what is the initial DSCR? That is the only metric I look at initially when I'm evaluating a deal right off the bat. I don't look at a lot of numbers on the front end before I say yes or no until I do a really detailed underwrite. And we'll talk about that. So debt, we're going to go through this in detail in a future slide. The second is E, which is the experience and expertise of the team that's going to run the investment, the general partner team, and their track record. Okay, we're looking at the experience, we're looking at their expertise, and we're going to talk about how to judge that and how to vet GP teams. The A is accounting. It's the returns, the metrics, the underwriting, the numbers. Okay. Obviously, the numbers, most people look at these as the most important part of the deal. I actually look at it as one of the least important, and it's the last thing I look at. And we'll talk about that as we go through this, because I do things a little bit backwards, but I think it does save a lot of time for people. And if you're looking at a lot of deals and you're really busy and you don't have time to spend hours on each deal, this is going to help you get through it a little bit quicker. And then the L is the location, the market of the property, the submarket, the neighborhood, and what are the area risk. And this is basically all I look at when I'm vetting deals. It's going to be in one of these four categories. So let's talk first about D, which stands for debt, structure, and the risk of the debt. This is by far the most important thing, because you can have a really good general partner team with a bad deal structure and they will get in trouble. You can also have a great structure and have a mediocre team, and the fact that the debt is structured correctly, it will save them. So I look at debt structure as one of the most important risk factors. So the most important thing with debt structure is, are you first in line after the bank? So we're going to assume that all the deals have leverage on them. No one's paying cash that I'm aware of. And are you the first person in line after the bank, or are there other people in line before you? So I'm going to say, do not do deals with preferred equity. Now, to go back to a previous lesson, I'm not talking about a preferred return. I'm talking about preferred equity. So this can be a little confusing. Preferred return is, when as an investor, your priority. So you get the first 8% of the returns as distributions. And then after that, there's a split between the limited partners and general partners. Pref equity means that someone or a group or an entity is stacked above the debt that's on the deal, and then they get preferential treatment. It could be they get paid back first. It could be they get a certain return before anyone gets any money. And you do not want to be in a situation where preferred equity is between you and your money. So I'm going to say, do not invest in deals with pref equity, because you are not the first person in line after the bank. Next thing is no second liens or mezzanine debt. So make sure that there's the bank loan and then there's you. There may be different classes of shares, and you may need to clarify that the different classes of shares aren't being paid in different orders. Generally, it just means a different set of returns for the different classes of shares. So no second liens, no mezzanine debt. And I've seen deals where there's a bank loan, there's a second lien, there's mezzanine debt, there's pref equity, and then there's the investors, and they're like fourth or fifth in line to get things. So that is not a good structure. So if you're going to learn about the way to de-risk your deals, learn about debt structure. I think it's even more important than the numbers or the underwriting. Okay, does the business plan need a capital event in the first 5 years? So a lot of deals, and it's becoming a little more rare these days, but definitely 3 or 4 years ago, a lot of deals were planned with a capital event in the first 3 years. So they were being bought on bridge debt, and then they were going to sell the property or refinance. So when I say capital event, just to go back to some of the previous lessons, the capital event is either a sale or refinance. It means they're bringing capital into the deal through some kind of an event. Usually it's a sale, it could be a refinance. If the business plan needs a capital event in the first 5 years, I would say no to that deal. So that's going to include bridge debt. If a person, if they have a refinance planned in the business plan the third or fourth year, you need to really investigate what happens if that refinance is not available. There's a lot of people that would love to refinance their deals right now from 2021 and they can't. So research that, find out if a capital event in the first 5 years is necessary. If it's not necessary, you might be fine. Maybe like, hey, we want to try to return capital in year 4, do a refinance. We think the market's going to be better. We're going to give people back their money, and then we're going to continue on. That might be okay, but if it has to happen or there's a problem, that's a serious issue. So research that. Never invest in debt structure you don't understand. If you get into the debt structure and it seems complicated, I would not invest in it. So really you need the bank and then the investors. And if there's things besides that, then the debt structure might just be too complicated and it may not be a good deal. Loan type and term, this is super important. I am recommending 7 to 10 year fixed rate debt. Agency, that means Fannie Mae or Freddie Mac. It could be HUD. HUD has long-term loans that are fixed rate. They usually have 10 years on the debt. Possibly a bank commercial loan or a CMBS, which is a commercial mortgage-backed security. One thing to be aware of on regular bank loans or CMBS loans, they're higher interest rates. So I don't know why a person would take one of those loans when they could just get an agency or a HUD loan at a much lower rate. So if they're using bank or CMBS, I would ask the operator, why are we getting these loans? And these loans may mean negative leverage. So if you're getting a cap rate of 6, you're buying a 6 cap, and you get agency debt at 5.3, you've got positive leverage there. You got 70 basis points of positive leverage. If you're getting a bank loan or CMBS at 6.5, you're in negative leverage. So basically, you could look at the same deal with 2 different types of loans, and it could be positive leverage or negative leverage. And we talked about locking in positive leverage. So if they're getting a bank loan or CMBS, I would ask the question, why are we not doing agency, Fannie Mae, Freddie Mac, or HUD? Because the rates are typically lower. And maybe that would be a deal to possibly pass on. However, I wouldn't say no for sure on a bank loan or CMBS. On some types of commercial real estate, you cannot get agency. I mean, Fannie Mae and Freddie Mac don't loan on storage. They don't loan on other types of commercial real estate. So there may be a good reason, but generally in multifamily, we want to use agency or HUD. If it's a loan assumption, there needs to be a minimum of 5 years left on the loan, okay? So what's awesome about agency debt is it can be assumed. So there are deals out there where people closed in 2020 or 2021, and they were getting like a 3% interest rate. And right now the market's a little bit over 5. You can go in and buy the property and assume those loans, okay, and get that low interest rate. Now, if you're looking at a loan assumption in a deal, you need a minimum of 5 years left on the loan, okay? Don't do one where there's 3 or 4 years, because the business plan is going to need a capital event in the first 5 years. Remember our rule that's up there. So minimum 5 years left on the loan, and make sure the operator is not overpaying on the loan. What was going on with a lot of loan assumptions, and I've seen these deals before, operators were paying more on the deal to get a better deal on to basically to get the loan assumption. So instead of a property that might have been a 6 cap, they were paying a 5 or a 5.5, thinking, well, we've got the positive leverage on the loan. The loan is not an asset. So if it cash flows good, you shouldn't be paying any more. And if rates go up, or if you have a problem with rates 3 or 4 years from now, and you overpaid for the deal and your cap rate is lower, you're not going to make money on the back end. So it's very important not to pay more for a deal because it has a loan assumption with a low interest rate. One of my best operators taught me that last year, and I'm really grateful for that because I didn't really understand how that worked. No bridge debt. Variable rates are very risky. Just say no. I would not do bridge debt unless you are a very wealthy person and you've got money to like put at risk. And maybe you're a gambler, you may get some higher rates. There's a good chance you could lose money on those. No one knows what future interest rates are going to be. I would just go with good old boring 7 to 10 year fixed rate debt and go for safer deals in real estate. I don't feel like real estate is a home run business. I feel like that if you invest in safe deals, you're going for doubles, you're going to get some home runs in there, but you don't want to strike out. You don't want to lose money. So I'm recommending staying away from bridge debt. No one knows future rates, and there's other risk involved with the bridge debt. So another problem is bridge debt increases risk even if rates don't increase. Okay, most people don't think about this. So what does that mean? There's two problems with bridge debt. One is the debt is for a much shorter amount of time. So generally, bridge debt is 3-year debt. So if you have problems on the deal, if something goes wrong, you have 3 years that you're going to need to refinance. Now, you can have extensions, but a lot of times the extensions are conditional. They're at the pleasure of the bridge lender. And you're basically trying to, take your deal off from a very short runway, and you might have problems. If the deal runs into trouble, you don't have a lot of room. So even if the rates go down or stay the same, and no one knows what's happening with rates in the future, I don't care what anybody says, you have a short runway there and you've got more likely to getting in trouble. The other problem is the loan agreements on bridge debt are not standardized. So when you get agency loans or Fannie Mae, Freddie Mac, it's really boilerplate. They're very standard loan agreements. They all look about the same. They've got to do a template basically from the agency or from HUD. Bridge debt is like the Wild West of lending. There could be any conditions. I ran into a situation recently where there was a person, it was a really good operator, supposedly. They had 8 loans on bridge debt, and one of the loans went bad or something happened, and they called in every loan. So basically people are having problems where properties have to be sold, and they were saying, hey, this was distributing, the loan was being paid. So bridge debt brings increased risk even if the rates don't go up. It's a shorter runway, and the loan agreements are very, very difficult to understand. And as a limited partner or passive investor, you're generally not reading all the loan agreements on these deals. So I would just stay away from it unless you're a very experienced investor and you want to segment off some of your investments for riskier things. But if you're going to take that kind of risk, I think there's other things to invest in, like private equity or being an angel investor or venture capital. If you want to hit home runs, they're better vehicles. I don't think real estate is a home run business. Okay, the next thing is cash flow or no go. I'm not sure if I made that up. I thought of that when I was writing this. I hope I did make it up because I really like it. So I'm looking at the DSCR on the deal on the front end right away. And this is the first metric I look at. The DSCR is a measure of cash flow. It's the ratio of cash flow to the debt payment. So if a DSCR of 1.25 means we're getting 25% more cash flow from the get-go at the current numbers when we take over the property than what the debt is. Higher is obviously better. 1.5, 1.6, 1.7, they're sweet spots. You get up to 2, and you may want to be borrowing more money. Maybe they're not using enough leverage. And if you have positive leverage, you want to borrow more money. But anything more like a 1.25 to like a 2 is fantastic. I think 1.5, 1.6 is kind of a sweet spot. It just gives you more runway. Deals need the cash flow day one. So we're looking at deals that cash flow. We're going to do better management. We're going to raise rents. We're going to maybe improve the property so we can raise rents more. But the cash flow, the deal is to cash flow from the get-go. If the deal cash flows from the get-go and you've got great operators and you got fixed rate debt, that makes the deal a lot safer. You're trying to buy a deal that basically is good from day one. It's a healthy business, but we're going to go in and make it a lot better. And that's where you really make your money. You don't take a lot of risk because leverage takes care of the returns. So we'll talk about that in a future slide. Okay, next is the experience and expertise of the GP team. There is no substitute for experience. So you're betting on the jockey, not the horse. It's overused in the business, but I can't think of a better way of putting it. You really are betting on the team. And I'm going to emphasize team on this, not just one person on the deal. Okay, so the sponsor experience in multifamily, full-time, I try to get people that are 10 years plus, if I can get that. That is kind of the gold standard. It's not always possible. There are a few people around that went through the financial crisis. If you can find those people, it's gold. Most people that went through that were operating then are like retired because they have so much money. But there are people around that went through the financial crisis. Try to get people that have done 10 years. If it's not quite 10 years, they've gone through a few deal cycles and they have a lot of experienced people on their team, but try to achieve the 10 years. Size of the deal, 100 units minimum, bigger is better. I won't even look at anything under 100 units. The smallest deals I've done are around 120 and up. I like stuff that's 180, 200. My first deal was a 296, which sounds really huge. But 100 minimum, you want to have a bigger deal. And the reason why is it is no harder to run 100 units as to run 50. And 50 is actually more difficult in some ways. You need the same staff. They don't cash flow as good because you don't have the same number of units. And property managers will send better management teams and better employees if you're using third party to bigger deals. They want to send their A team to the 300 unit. They don't want to lose that business. So basically set up your minimum. I would set up 100 units as a minimum size deal. Don't invest in rookie deals or with small teams. There's some amazing people out there that are just getting started in the business. There's a lot of smart people. I would be really careful about investing with people that it's their first time out or their first few deals, or they haven't gone through at least one deal cycle, unless they've been in some kind of auxiliary business in multifamily for a long time. So they've been in the business a long time. Maybe they came from a family. Maybe they have a background. And also watch out for small teams. So a small team would be like, an example would be maybe a husband and wife team, and they're raising $1 million and they're going to go out and do like a 32 unit property. And it's just a husband and wife team. And my worry with that is, they're driving home one night from a restaurant, get hit by a car, fatality, they're both gone. Who gets this to the finish line? So you want to have 4 or 5 competent people on a GP team that will be there in case somebody has a health issue. So stay away from the small teams and go for experience. Don't invest in rookie deals. Avoid emotional investing. And this is really tough sometimes because you like the GPs or the property. If the property is local, you're probably going to do a drive-by. And if you drive by an A-class property that's near your house, it's going to look really pretty. It's going to look really nice. And you might get emotional. Also, some of the general partners are extremely charming and wonderful people. I would rather invest with somebody that's kind of a jerk that gives me great returns than somebody that is a really super warm, wonderful person. But there's all types out there. But avoid investing with people just because you like them, and avoid falling in love with the property. Fall in love on the property after they sell it and make you a lot of money. And on the GPs, just be careful. Don't let them charm you. Try to remain unemotional if you can. And the thing is, all the people I partner with, I really like. So, you need to like them, but don't be charmed by marketing, and don't be oversold on the deal because you like the people or like the property. full cycle exits are really what's important. So we're trying to look at full cycle, what's happened with exits, what people have done, the past investor returns, and the reputation. So one thing is, if people have been in the business a long time and they've had a lot of full cycles and they have a big portfolio, they'll have a reputation you can research, you can find out about them. And there are ways to research this. Also, a person that has a big portfolio, they are more worried about their reputation for future deals than they are one deal. And so these people generally have more liquidity, they're more experienced, they can borrow money if they need to, and they know to survive in this business, they have to maintain their reputation. And once you have a really bad exit or foreclosure, it really, really harms your reputation, harms your ability to raise money, to get a bank loan or whatever. So you want a deal where it's big enough as far as the portfolio that they're going to be really concerned about the reputation. That's another reason I don't like rookie deals, is because I don't know how someone is going to sail in a storm until they've been there. And I mean, I've heard of deals where it was a newer team and the deal went bad and the GPs thought, well, we're not really going to make money in this deal. And everybody just kind of threw their hands up and quit. You don't want that. So invest in deals where people have a good reputation and where you know the person's interested in maintaining the reputation, because that might just save the deal. Ask about the current issues they're having. If they have distressed deals, and that's okay. If they've had any bad exits, and a bad exit means a lot of things to different people. I see it as just any time the returns are not as good as what people expected. It doesn't mean there was a foreclosure. It doesn't mean people didn't get their money back. I mean, limited partners, a lot of times they'll have an exit where they made a 12% return. And if they were promised an 18, they see that as a terrible exit. It's really not a bad exit, but I understand. And have they had capital calls on their deals? And then what have they learned? And when you ask a sponsor about their current issues they're having, they need to be really transparent and tell you. And if you ask someone that, say, has a portfolio, they're bragging about, oh, I've got a $2,000 door portfolio, or we've got $400 million of asset under management. If you're asking those people questions about their portfolio and what type of trouble they're having, and they say everything is hunky-dory and there's no problems at all, I would run. So basically, everyone that's in this business has problems. You have to be a problem solver. The bigger the portfolio, the more problems. And a good operator will be honest and transparent about it. And don't be afraid to ask about the issues they're having. And if they say there are no issues, I would not trust this person with my money. So I'd be very careful about that. Are GPs invested in the deal and how much? Very, very important. GPs need to be putting money in their deals. It's a good thing to find out how much money they're investing. Lenders usually require a certain amount, a percentage of the deal. Sometimes it can be 10%. And so you want to kind of find out how much people are putting in the deal. And if they are putting in the deal, I know GPs that don't put a lot in the deal, and their thinking on this is if the deal gets in trouble, they keep money on the sidelines in case they need to bail a deal out. There is some wisdom in that, but I still think people need to have skin in the game. So don't be afraid to ask about the money they're investing and find out how much. Size of the sponsor portfolio, we talked about this. When people are getting going, basically they're going to have 500 doors, 1,000 doors. You're looking at their portfolio size. I'm less impressed by the number of doors, basically as much as the time they bought the properties and how they did, and also did they scale too fast. So I know of a large syndicator in the US that didn't own anything in 2019. And by 2024, they had $1 billion asset under management. So they did that in really 4 years. Their first deal was really small. 4 years later, they have $1 billion asset under management. To me, that is scaling too fast. I think they may have some underlying problems and they may have bitten off more than they can chew. So I would look at the number of purchases they've made in the last few years. So some of the best operators I know didn't buy anything for 2 years. They took a break during the second half of 2022. They didn't buy anything in 2023, and they started buying again in 2024 when good deals started coming down. So they kind of took a break. They weren't seeing any deals. They're very disciplined. I like that. People that are getting in and building their portfolio now and starting to buy things, that's good. But always look at the scaling. If they come out of nowhere and all of a sudden they have $1 billion asset under management, I'm worried there's underlying structural problems. If they're saying, hey, we want to buy 2 or maybe 3 deals a year, and their journey in real estate and their acquisitions are pretty linear, that's a lot better. That's a lot smarter. So, keep that in mind when you're looking at portfolio size. Diversify investments in multiple sponsors, deals, and markets. Pretty much common sense. I mean, don't put all your money with one sponsor. Invest in different deals with that different sponsor or with the same sponsor. If you have money, if you've got a couple $100,000, put it in 3 or 4 deals, or 2 deals. Be strategic about it. Split it into different deals. I love it on my deals when people write big checks. I try to verify when people do that they're not putting all their money in one deal if I can, because I want people to spread their money out. But do multiple sponsors, network with people. Don't just have one go-to person for real estate, because if they get in trouble, you could have the whole ship go down with them. Different deals, different markets. I'm heavily invested in Texas right now. I need to be looking at other markets. I'm starting to do that for my passive investing. But go into those other markets and look at deals and look at different sponsors and spread your money around, especially as you accumulate more or you start having big exits on the other side when you get out of these deals. And then also in every deal, ask your sponsors, why are the owners selling? This is very important. Right now, as of 2025, you need to know why people are selling. And as we say in the business, no story, no deal. Right now, except for one deal that I've done as a GP, the 3 other ones, they have been forced sales that were going to go to foreclosure. They did not have any choice but to sell. And so right now, at this moment in time, I'm looking for deals where people have to sell so we can get a screaming good deal. So find out why are the owners selling. And if there's no distress on the owner's side or no distress with the property, or there's really not a good reason they can articulate why they're selling, I would stay away from that deal, because I think there's better deals out there at this moment in time right now in 2025. Okay, accounting, metrics, underwriting. This is all the numbers and the nerd stuff that people look at. Equity multiple right now, this is as of 2025. You need to be looking at a equity multiple of 2 to probably 2.25. Might be a little better. I think if people are promising an equity multiple, a 2.5 or higher, and it's not development, and we'll talk about that in a minute, I think they're over promising. So if we have an equity multiple of 2 and we're doubling people's money in 5 years, it may end up being an earlier exit. And so the metrics will be a lot better. We always look at a sale if we can double people's money, but equity multiple like 2 to 2.25 is kind of the sweet spot right now. So anything below that, I mean, if you're not going to double your money, why are you investing? And anything above the 2.25, I would be suspicious that they're over promising, especially if they're using fixed rate debt. IRR, I'm looking around 15 to 22% on a 5-year business plan. Most IRRs you're going to see right now, if people are being conservative, are under 20. If it's under 15, then you may want to, I don't know. It doesn't look like the deal is good enough to really warrant investing in. Right now, 16, 17, 18, kind of a sweet spot. Above 22, I think people are over promising and they may not be able to deliver. And don't get sucked in by the promise of high returns, because all it is a promise, and it may not be one the operators can keep. Average cash on cash, 6 to 9%. The sweet spot right now is about 7 to 8, probably. When you get above 8, you start getting in a zone where it may be hard to deliver on, and you just got to be very careful about that. If the cash on cash is under 6, I don't think the deal is good enough warrant investing in. So just keep that in mind. That's a range of what the metrics are right now, and hopefully deals will do better than that. Or organic rent growth around 3%. If the rents are below market and they're going to raise them, it takes time. So when I say organic, basically the assumption is in the underwriting that the market is going to go up 3% a year. And over time, they're going to catch up the below market rents. Okay. It takes time. You can't do it in a year. It takes about 2 years really to catch them up. If you go into property and they say, hey, the rents are 15% below market, and you go in and try to raise everyone's rents $150 a month, your occupancy is going to drop significantly. So if you raise rents, let's say 10% on everybody, and the occupancy falls 10%, did you raise rents at all? And the answer is no. If you don't do it slow enough to keep the occupancy up, you're not really raising rents. You're just getting more rent from fewer renters, and it really stays about the same. So be careful about that. If they're going to go in and raise rents very quickly on a property, you're probably going to lose occupancy, and the underwriting their thinking is flawed, in my opinion. Watch out for large cuts in expenses. It's very hard to cut expenses on a property. Insurance and taxes have tended to go up quite a bit in the first year. In the past, that is something that's changing right now. We're seeing on renewals in Texas, insurance is actually going down. Okay. So there is opportunity to take over a property and reduce the insurance. I'm seeing that on 2 deals right now that I've looked at recently, one that I am involved in. The other one is one of my first GP deals. We just renewed the insurance and it was cheaper than last year. So insurance, at least in Texas and our market, is starting to decline. So there might be an opportunity there. If you get a new policy, that's a cut. Also, some of the places, the markets, the taxes are just too high. And right now you're able to buy deals below what the taxes are. So let's say the taxes are assessed at 15 million and you're buying at 13. Well, you're going to be able to protest that next year and get the taxes down because you just bought the property at 13 million. So there might be an exception there on taxes and insurance. On other expenses, I would be very careful. And on the insurance, you need a new quote to make sure that you're right on that. And then also realize the insurance can be jack them right back up the next year. And on the taxes, you should be able to protest that, but that's not a given. So be careful if you see a large cut in expenses with those 2 exceptions, possibly. Management value add versus construction value add, avoid complexity. I am a huge fan of the management value add, which means we're going to improve the management. We're going to improve the service to the residents. We're going to raise rents to market. We're going to maybe do a few things as far as some amenities. We're going to basically get the management on track and improve the management. A construction value add is we are going to renovate units, okay? And we're going to raise rents for the most part, maybe add some amenities. The problem with the construction value add is that you may not be able to raise rents as much as people think, and the cost of construction may be higher than you figure in your business plan. This is particularly true right now because there are tariffs out there and they may affect building supplies. So no one can tell me 3, 4, 5, 6 months from now what construction costs are going to be. So right now, I favor the management value add. The management value add works really well when a property is distressed or when the seller has to sell. In my opinion, the best value add is getting a really cheap price. And I've learned that from operators. So that's why we want to make sure we have a story for the deal where we're buying it below market. We can improve the management. We can value add. Maybe we renovate some units, but the deal is not dependent on that. And we do renovations. It's when somebody moves out. In the past, people have tried to raise rents $150 or $200 a month to basically broom the tenants out so they could rehab, they could bring new tenants in and they can raise rents on them. And that does not work very well. It's a very complex business plan. And if you're doing using bridge debt, which was typical, if rates go up, you're going to get in trouble doing that. So avoid complexity, look at simple value add. If you see a business plan where they need to do a refinance within 3 years with capital event, and they're doing a ton of construction, and they're going to spend $4 million on CapEx. I would stay away from those deals right now because I think there's deals out there where you don't have to do that complex of a business plan and you can still make plenty of money. Positive leverage. Is the purchase cap rate higher than the loan rate? So if we're buying a 6 cap, we want to have debt that is in the fives somewhere, low fives. The bigger the spread, the better. So look for positive leverage. Check that out. If the people say they're buying a 5 cap and they're getting the debt at 5.5, they have negative leverage. So make sure you have positive leverage, and the only way to lock that in is get fixed rate debt. Takeover risk. Is the current management a reputable third party, or are they a good reputation vertically integrated company? This takeover risk is really, it's on my mind right now because I've got one deal I'm a passive in that's in trouble right now. And it was a takeover from a Lone Ranger. It was a smaller deal. It was 100 units. They took it over. The person was managing the property on bridge debt, and it was a Lone Ranger. He was living there, self-managing, doing the whole thing himself. They bought it from them. And in the due diligence, maybe, I don't know, they didn't catch everything, but they got in there and a lot of the tenants were real bad people. And a lot of them were living under fake names. They were felons. Their background checks were not correct. There was a whole bunch of fraud that wasn't caught. And if we had taken over the property with a reputable third-party manager, that would have never happened. And if we took it from a great operator that was vertically integrated, that would have been a little bit less risk also. So when you take it from a Lone Ranger or family, you don't know what their business practices are, and they may be desperate to sell. And so there could be fraud. That deal will end up being okay. We're going to get through it. But that is a lesson I had to learn the hard way on one of my passive deals, that takeover risk is much higher if the current management's not a third party. And a lot of times when we bought properties, we've kept the current management there for at least 6 months to try to make the transition smoother. So takeover risk is real. If it's a Lone Ranger deal or buying from a family and it's not a third-party management company involved in the deal, there's a lot more risk. And I'm actually going through right now and learning that on one of my passive investments the hard way. Reserves. You want a minimum of 6 months of expenses, and this is in addition to the CapEx budget. So if basically the expenses are $50,000 a month, you want 6 months, so you want $300,000. It's really simple math, okay? And I would include the mortgage as an expense. So you want to have reserves. You want to be able to survive problems. And the CapEx budget, some of that can be moved toward reserves, but in the beginning, those need to be two separate things you look at as far as reserves. Okay, so be aware of that. Make sure there's plenty of reserves. If they go through their CapEx budget and they're spending more money than they need to, and the reserves are being eaten up because something goes wrong, that can be a real problem. You can never have too much reserves. And then 10, beware of unusually high preferred returns. So preferred return is not exactly a metric for underwriting, but some groups are trying to suck people in with preferred returns that are beyond the market. So what's typical is 7 or 8% on a preferred return. I've seen some with 9 that starts getting high. 9 is kind of like the yellow. Anything above 9, unless you're some kind of special class of shares with no upside, it is not. It doesn't make a whole lot of sense why they're offering that. So I'd be very careful. To me, a high preferred return is a red flag. I would, why are they doing that? Why can't they just do an 8% preferred? It's usually somebody that's in trouble. They can't raise money from their own investor base because they've got deals that are distressed and they're just trying to suck money in, offering a preferred return. And remember, a preferred return is no guarantee. It's not a CD. It's not going to pay out distributions. And the bigger of the spread between a preferred return and the cash on cash, it means that preferred return is going to roll. So I would be careful about being sucked in by preferred returns. And good operators won't do that, by the way. If it looks too good to be true, it's too good to be true. So if you have any deal that just looks way too good on the front end and the returns look too high, they're out of these ranges and it looks too good, I would pass on it. If you ever get your gut feeling there's something wrong with the deal, pass on it. So listen to your gut, run the numbers, but listen to your gut. Okay, location and market, area risk. Invest in markets with above average population growth. Right now, this is the Sun Belt. It's the Gulf Coast. It's Arizona. It's Texas, obviously. It's Florida. It's Georgia. It's the Carolinas. Tennessee has great population growth. So you want to invest in markets with above average population growth. There's a lot of people moving because especially in B class and C class, you can't build those properties. So at the cost, now A class you can build new construction, but in B and C properties, workforce housing, affordable housing, when you have population growth, those rents are going to go up if people are moving in because you can't make those type of properties. You can't build them anymore. Invest in markets with great job growth, obviously good economy, wage growth, rent growth, things that are resilient in a recession. So I go back to the great financial crisis, 2008, 2009, Texas, Houston, and Dallas, I'm more familiar with, definitely in Houston. We did a lot better during the financial crisis than most part of the country because we had oil and gas, which actually did pretty well during the financial crisis. So look at places that can blunt out a recession because they have good job growth, wage growth, rent growth, which you can research basically with the operator if they're looking at CoStar reports and things like that, and look at places that have a good economy. Avoid smaller markets. Okay, don't buy a small property in a really small town. The exception to that is if there's strong growth or expansion of a major market. Okay, so I'm going to use an example here, Conroe, Texas, which is just outside of Houston on the north side. It's the area I live in. 20 years ago, Conroe was a really small town. It would have been not a great place to invest, in my opinion, at the time. It was a small market. However, Houston has been pushed out and the population growth up here has exploded. So Conroe is a boom town right now. So if you have a small town and it's on the border of a large place, a large market that's expanding, there's a lot of these in Dallas. There was like Plano, Flower Mound, and now it's like McKinney, Denison. With Houston, you've got Conroe to the north, the Woodlands. You've got Katy to the west. So the city is growing out in those directions. If you look at San Antonio and Austin, you've got New Braunfels and San Marcos in the middle. Well, those were small markets, but now there's a massive expansion going on where San Antonio and Austin are basically growing together, and these small markets are doing incredibly well. With those two, it might be a little bit too late to get in on, but when the large market's expanding and these small towns are blowing up in population and it's being supported by a big market, that's an exception. But I wouldn't buy a very isolated place, a small market, which is not getting a lot of stuff. Okay. Know the market and submarket and the neighborhood. Submarkets are very important. For instance, here in Houston, you can have a great neighborhood, and then you could have a neighborhood that is a mile away that's a bad neighborhood that has a lot of crime. And you didn't know, is the neighborhood on the way up? Is it improving or deteriorating? You need to do some research on the submarket and the neighborhood. Understand crime rates in the submarket, property location, avoid high crime. You can look on crime maps. There is a website called crimegrade.com that I use for that typically. Look at the map around the complex. I had one time I was looking at a complex for crime, and the crime area didn't look that bad, but like right on the complex was like, that was a high crime area. Like there was crime happening inside the complex on the crime map. So that was definitely one to avoid. So understand the crime rate in the submarket. If you have high crime, it's very hard to manage out of. If units are getting broken into, people's cars are getting broken into, if there's drugs in the area, it's very difficult to manage out of that. So stay away from high crime areas. There is crime everywhere. Just because you're in a suburb in a low crime area. It doesn't mean there'll never be a crime on the property, but it does avoid a lot of the problems. So stay away from high crime areas. Understand the market. Does the sponsor live in the market? Is it a new market for the sponsor? I like it when the sponsor and most of the sponsors live in the area. So at least within, 30, 45-minute hour drive, something like that. When I do GP deals, I'm doing them mainly in Houston or a market I can drive to within 2 or 3 hours. I don't do, deals in, Georgia or something. I have to hop on a plane. It doesn't make any sense. Also, if a sponsor has been very successful in a market, let's say they're in Houston, and then all of a sudden they go, hey, we're going to go buy a property in Charlotte, North Carolina. I would be very hesitant to invest with them the first time out in that new market. When you go into a new market, it's totally different and you're much prone to making mistakes. So if you want to invest in Charlotte, find somebody that's really heavy in that market and has a good track record in that market. So be careful about that. Avoid flood zones, coastal properties. Look on a flood map. The FEMA flood maps are public. You can look it up. Is it in a flood zone? Ask the operator. Coastal properties, try to stay like 10 miles inland minimum, 50 feet above sea level. This will prevent storm surge. If you have a property and it has like a beach view, I would be really careful with that. Now, one exception to this is if it's a mid or high rise property. Like a lot of properties in Florida that are A-class, they're built up to where the units are all 40 feet above the ground and there's parking garage on the bottom. And obviously people have to move cars if there's a hurricane, but the units aren't going to get flooded. So if the property's constructed where there's a natural elevation off the ground, that might be acceptable. I'd still be careful about it. Obviously, the coastal properties, the insurance is a lot more expensive, but don't buy a property that's right on the beach, right on the coast. And don't buy something that's near a river or something that floods. Just stay out of flood zones. The interesting thing on flood zones too is you can have a larger property and only one corner of it's in a flood zone, and it's basically considered in a flood zone. So you got to be really careful about that too. I've ran into 1 or 2 properties like that I was looking at. So stay out of flood zones. Don't get properties right on the coast unless they're high rises and they're going to be above the water if we get a hurricane. Know every natural disaster risk. With Gulf Coast hurricanes, it could be wildfires in different parts of the United States. They could have earthquakes. West Coast has earthquakes. Could be tornadoes if you're in Kansas. Know the natural disasters, the history around there. We have insurance for natural disasters, but be careful about investing in areas where natural disasters are common. Know the landlord tenants of the state and the eviction policies of the local courts. The tenant laws of the state are really, they police the relationship and can we evict people that aren't paying? And if you don't pay, you can't stay. That's done by the state. There are certain states I will never invest in because the tenant is at such an advantage over the landlord. Places like New York State, California, Washington State in particular, Seattle. I've heard Chicago is the same problem. I've heard New Jersey is the same problem. So there are certain states that you can eliminate because the tenant laws are not favorable. And then you also know the eviction policies of the local courts. For instance, here in Houston, the state of Texas says what the law is, and the local courts in the county, Harris County, Montgomery County, Houston, they really enforce the eviction policies. So you could have a situation where the tenant laws are kind of even, but you could have a municipality that is not enforcing the law and the courts are super lenient and they're just letting people stay and they're not paying their rent. So there's some states to definitely avoid because of that. And then if you're going into a state you're not familiar with it, it's a good idea to talk about with the property management people or the sponsor, what are the eviction policies of the local courts and how do they function? And are they actually evicting people? During COVID, there was like no evictions. The courts were closed. That was a huge problem. Okay. Is there new apartment construction in the area? And is there barriers to developing new properties? Okay. The new construction really only affects A class. If you're in a B class or a C class property, new construction should not affect you too much because the rents are so much higher that you're not going to really have a big issue with competition. Now, if you're buying an A-class property and someone builds another A-class property down the street and they're trying to lease it up and they're giving people 2 months of free rent, you're going to see your occupancy drop. So you need, especially with A-class, you need to find out if there's anything being built in the area or planned, or what's coming online in the area. I'm going to use Austin, Texas as an example. That was a super hot market. There was a ton of new construction. They overbuilt, and now rents are falling there. They're not going up, they're actually falling because it was overbuilt. So be aware of that, especially if you're looking at A-class properties. I prefer B-class and C-class properties because you cannot build new construction and rent it and make it a competition. They're not building them anymore, basically, something you can rent that low. And is there barriers to developing new properties? Some of these small towns hate development. And so if you're in a market where a big city is expanding and you've got a small town, they may be limiting development there. So if that's the case, if there's a lot of population growth and you've got a city that's trying to stop progress, they want to keep it a small town, they may limit development, which may really help your property because there's a supply and demand. There's no supply coming online, demand's increasing, it may help. So look for those type of opportunities. You can talk to operators in the area and find out if there are barriers or if this city's development are friendly. So we've gone through our deal method, and I'm going to show you the shortcut here. And this is the quickest way to use this in a way that is really concise and short. Okay, master the art of elimination. So you want to look at D, E, and L first, and look at the numbers with the exception of the DSCR last. So this is the way I eliminate deals in like the first 5 minutes most of the time. I don't waste a lot of time on deals. So debt, structure, loan type, fixed rate, DSCR. So if I know I don't want to do bridge debt, when I look at a deal, what kind of debt? That's the first thing I go to. Oh, they're getting bridge debt. Okay, that's a no right there. I just said no in the first 10 seconds. Okay. It could be that they got mezzanine debt or they're getting preferred equity. Well, I don't want to do this kind of deal, so we're done. The rate's not a fixed rate. It's a bridge debt. We're done. The property's not going to cash flow. It's got negative cash flow. We're done. So the DSCR is going to be under 1. When you get agency debt, the 1.25 DSCR is about a minimum. So if they're getting agency, it's going to cash flow right away, or they're not going to get their loan approved. Also, be very careful on deals where they say they're going to get an agency loan and they switch the loan type to bridge at the last minute. Do not participate in those deals. Don't sign your documents. And if you have signed them, say you're canceling, they don't want your money back because they're not holding to what the original agreement was on the loan. Be very careful about that. So debt structure, look at that first. The debt structure is basically the biggest chance of you getting effed on the deal. And when I say F word, I mean foreclosure. Okay, banks, when they take back properties, that's when people lose all their money. So be very careful about the debt structure. I look at that first. I say no really quickly. Experience, expertise of the GP team, and the track record. There are 4 types of GP teams that I'm aware of. There are people that I already work with and I love working with. There are people that I have not worked with yet, but I definitely have them on my radar and I'd love to work with them in the future. There are people that I'm not aware of that I'm meeting in the business and I don't know about them or their business. And I have an open mind. I've got to get to know them and I got to research it. And then there's people that I'm aware of that I don't like, or they're incompetent, and I don't feel like they're people that I want to work with. And I'm afraid they're going to lose investor money or they've lost money in the past. So there are certain GP teams that they send me a deal, it's an automatic no because I don't like the team. I don't like the track record. And I'm keeping tabs on people and I'm in the no on that. So I look at that really quick. Now, if somebody brings me a deal and I've worked with them before, or I really want to work with them and they're on my radar, then real quickly I can say I need to take a longer look at this deal and really seriously consider it. A is accounting, returns, metrics, underwriting. Remember, we're going to look at that last because that takes more time. So let's go to the next one. Location, market, submarket, area, risk. Okay. I know I don't want to do deals in California because of the tenant laws and the crazy business environment out there. I don't want to do deals in New York. If it's a GP deal, I want to do a deal in Texas. So I want to be able to drive there within a few hours. Worst case, I love Houston because everything is within 45 minutes, but I'm doing a deal in San Antonio right now. I'll look at Dallas. I'll look at stuff. So if someone calls and says, hey, we want to do a GP deal and we want to do it in Chicago, well, that's a no. Madison, Wisconsin, that's a no. I've had these deals sent to me and by really nice people that I really like. The location didn't work for me. So you can go in and look at the D, the debt, the team, the E, and the location. And you can usually, if these don't fit your buy box, you could say no in the first 5 minutes. Look at those things first. Say no quickly. Don't waste time going through the numbers because if the debt structure or the loan type is a no, or the experience or expertise or GP is a no, or the location, the state it's located is a no, don't even spend time looking at numbers. I know it's so seductive to look at the numbers and underwrite all these deals, but don't waste your time. Just say no based on those three things, and then look at the numbers and the accounting last after you decided, hey, I like the way this deal's structured. This GP team really rocks. I like them. And I would love to do a deal in this location. And if you're a passive, you're very liberated because you can do deals pretty much anywhere. And I do recommend looking at other states and other markets as a passive. If you're a GP, I think you should stick with your area that is in a decent driving distance to do your deals so you can be available and you can keep an eye on the property. But look at the numbers last. Don't waste time. Learn to say no. You can look through the D, E, and the L in like less than 15 minutes on every deal. And a lot of times I kill deals in the first 2 minutes, just looking at those factors. So key points for investors, we're going to have our conclusion here. We're going to value consistent returns over chasing home runs. If you're chasing home runs in real estate, you're going to strike out. If you swing consistently in baseball, you're going to hit a home run every once in a while. And it's the same thing in real estate. So don't chase home runs. Go for consistency, go for safety, try to not lose money, and you're going to do really well and you're going to have some great results. Develop your own investment criteria and principles. I kind of laid out a framework of what mine are. Everyone's different. Everyone's got to lay out their own criteria. If you live in Georgia or North Carolina, you're probably going to want to start investing in your own backyard. Whereas a GP, those would be too far away for me to be a general partner on. So your criteria is going to be different than mine. But I would pay close attention on the items I did about debt and about the GP team and some of the numbers, and really put that into your criteria and strongly consider it. If something is an outlier outside of those, I'd be very careful. Look at as many deals as possible. Say no quickly. You should be saying no a lot. Don't have a small deal flow and being saying yes all the time. Say no quickly. Say no permanently. Don't get emotional in deals. It's better to say no, ends up being a great deal, than say yes to a bad deal. So have your default is no, basically. And look at as many deals as possible. Increase your deal flow. Learn how to say no fast, though. And tell sponsors what you're looking for. If they send you something you don't like it, tell them why. Tell them why you're saying no. Use your time, energy on deals that fit your criteria. So do the deep dive, do the research on deals that fit your criteria, and they go through your initial screening process. Don't waste hours underwriting a deal and decide you don't want to invest in California or whatever because you don't like the state. That's a complete waste of your time. I have done that before. I wasted a lot of time on a deal one time because I really wanted to invest in it, and I didn't go through my criteria very well. So don't do that. Use your time and energy, which is precious, on deals that fit your criteria, and then put your goals in writing and take action on good deals. I had an experience earlier this year. I was talking to one of my investors, and she was telling me, hey, I really want to do 4 deals this year. She was telling me this real early in the year. And I thought that was fantastic because I was like, I want to do 4 deals as a GP too. And so if you have an idea of what you want to do, put those goals in writing and get those goals and review them regularly, and set goals for how much you want to invest, how many deals you want to invest, how you want to split it up, and then take action on deals when they fit your criteria. Also, if you run into stuff and you're not sure and you're on this call or you're watching it, get in touch with me. I'll be happy to look at your deal and help you. I do help people look at other deals, and I want to help people from making mistakes because I don't want people to go into bad deals and lose money and then just decide this doesn't work for them. I want to help people do better in their investing. So put your goals in writing, take action on good deals, get your confidence, and don't be afraid to pull the trigger and decide at the beginning of the year what you're looking at, how much you want to invest, and how many deals you want to do. And I think that'll work a lot better for you.